It's been 2 weeks, so I missed everybody. And hold on one second. Where's my screen at? Oh, here. How? Sorry. Nick, how do I make highlight? How do I highlight? Can't highlight.
On a document?
No, how do I highlight myself as a speaker? Oh, wait, here we go.
Oh,
I got it. Spotlight.
I did it for you. You just right click and click highlight.
All right, good. Okay, so hey, welcome everybody. This is the Rookie Roundtable call. We teach real estate and we bring everything from basics to the most advanced things. All right, when it comes to real estate, there are many pieces to the puzzle of how you can do a deal, how to determine if a deal is a good deal. How do you take the most advantages from the legal perspective, from the accounting perspectives? There are so many things in the realm, or I like to call it like the big puzzle board of real estate. So today we're actually going to be talking about tax advantages. There's something that's really amazing that has come back. A lot of people know that they were saying that 100% depreciation is gone and it's going to go down and down and down and down. But this year, they passed something that is really advantageous for all of us. So, some of us were like, oh, this is the last year, but just kidding. It's not. I brought my CPA here. We're going to talk a little bit about the different tax advantages of real estate. We're going to share how I didn't pay taxes, even though I had, pretty large income, and how can you do that as well? So that's the piece of the puzzle that we're going to reveal today. Normally on these calls, what it looks like is I will come on, I'll bring a topic. Last week, 2 weeks ago, we talked about debt, all the different creative debt out there. And last week we were supposed to talk about teams. How do you put together a team? What team do you need, right? You have your third-party team, let's call it. You need your CPAs, you need your attorneys, you need property management, you need, I don't know, what else? There's lots of other things. You need your marketing team, asset management team. That's actually put more on the internal GP team. Title, right? Escrow agents, brokers, mortgage brokers, lenders. You have your real estate agents. Those are all different people that you need on your third-party team, which is important because if you're looking at a market and if you're looking to buy real estate, those are the people that are going to tell you the most about that market, right? Especially if you go and you ask for a referral for, hey, I need if you go into a market, the first person you should ask for and you're looking for a real estate deal is an agent, somebody that knows the market. And then you look for an agent, and I say this all the time, you ask the agent for a property management company. Hey, if I was to buy something here, what property management company would you refer? Then you reach out to this person and say, hey, this person so-and-so referred me to you, and I would love to get your take on this market here. If you're looking for, residential, if you're looking for 4-unit, if you're looking for 100 units, what class is it? Is it brand new? Is it class C? Is it value add? Those are the things that you have to get clear on first for yourself, and then you go and do your market research, right? And the way you do market research is you go through asking people. You have to talk to people. Within one day, most of the times within one day, I could probably know more about a market than people that can research all day on the internet, because I would just call people. So calling people and being like connected this way is really important. So for those of you guys that are watching on the social medias, join into the Zooms because you want to connect with people. And then from here, you learn, okay, well, who do I need to call? What do I say to these people? How do I identify my own buy box, right? The more information you have and the more you talk to people, the more you're going to learn. It's kind of like a circle, right? You have to talk to people so that you get the experience. The more experience you have, the more confidence you have to talk to people. And very quickly, you can identify all the things about a market just by talking to the agent and the property management company. right? Then you ask for another referral. Hey, besides that agent that you refer, is there any other agents out there that you like? Okay, then you talk to that agent and you do this is your due diligence process of finding the people that you want to work with in that market, right? And it starts with a referral. Hey, who do I know that lives in Fort Lauderdale, Florida? Okay, I know this person. Let me call this person. They're in the real estate business, right? Okay, cool, great. Hey, can you refer somebody to me? Can you refer an agent, somebody that knows what they're talking about? Okay, people love to refer other people. And then people love to be referred. So if you are, the way you should be is you should be someone that other people will refer you. That's how you should show up. All right. Okay, so normally what we do is we have a topic about one of these puzzle pieces that we go through. And then other times I will bring on some speakers, people that I personally work with. Okay, I don't just bring on speakers because they're cool or they're big out there. Unless I've worked with them or I've spoken with them and I can see their character, I can see their soul, their spirit, then I don't just bring them onto these calls. But Brent, my CPA, who I've been working with for a couple of years now, helped me really organize my life. I think that is one really, really important piece that you got to have put together is your accounting. Okay, most of the times what people do is they just stick their head in the ground and years later they try to figure out taxes. And I've been there. Okay, if you're there, that's totally okay. I've been there. I'm like, oh, I need to do my taxes. I need to do my taxes. Everyone dreads doing taxes. Now, I mean, I don't dread doing taxes because I know I have somebody I can count on. But I also need to talk to my accountant, Brent, over here about strategizing what we need to be doing. All right, so let me bring Brent up here. So this is Brent, but hold on before we start, Brent, I just want to go through the rest of the agenda. The rest of the agenda is that after Brent speaks, we'll have time for Q&As. If you have questions, please put it in the chat. And then we'll give you guys some time at the end to network with each other. So you want to be writing down what you learned. What is your takeaway moment? I want you guys to share that with each other at the end. What is my takeaway from this call here today? What am I going to do moving forward that's going to move the needle forward for myself? And also, too, what do you do? How can you serve? Right? If you can solve those things, what do I offer? What's the gift that I offer? And what do I need? If you can just answer those 3 questions in your breakout room, you're gonna be able to build your network. The goal here is to build your posse. All right. And speaking of building your posse, the best way to build your posse is to invite people that you want to work with onto calls like these. You attend a call together so that you guys can digest it and talk about it later. The worst thing is for you to hear something amazing here and then try to telephone it to somebody else. When you try to telephone it to somebody else, it ends up becoming like opposite of what you're really trying to do. They're like, what are you saying? It sounds like a scam, right? Because you don't fully understand what you're saying, but you're trying to explain it. So invite people onto these calls so that you can build your power posse. Those are the people that you guys are gonna learn and hear certain nuggets together and exchange. Hey, what did I learn here? Because I promise you today, listening to the conversation that Brent and I are going to have, you will take something away from it. And if you don't, maybe you got to turn your camera on and actually pay attention instead of doing 5 things at the same time. All right. So invitation here is for you to be here in a way that you're committed to getting something out of being on here today. If you're going to spend the most valuable commodity you have, which is your time, which I'm extremely grateful for you guys being here. But if you're going to spend that time here, I really want you guys to get something out of it. All right. So without further ado, I'm going to introduce Brent. He's been on here twice already, but everybody's always asking, when you bring Brent back on, how do I get his contact info? And I'm not just freely going to be giving his contact info out because he's a busy guy, but he's been generous enough to hop onto this call here with us today, and we're going to talk about some really cool things that's happening out there in the market.
Happy to be here. Happy to be here, Alex. Thank you so much.
There you go, everybody.
Yeah, this is awesome. Well, one thing I've loved about working with Alex the last couple of years is he is not afraid to ask questions. and he'll bring me back down to earth. Sometimes I'm like, hey, Alex, there's this new law and you can calculate the depreciation and amortize over the schedule. And there's this credit. And he's like, whoa. It's like, can you just break it down for me? What's going to impact me, or how can I use it? And I'm like, all right, we'll break it down and we can explain it. So, and on today's call too, if anyone's got questions, throw it in the chat, raise your hand. And I'm sure Alex, he'll kind of follow up with he'll have some follow-up questions and stuff so we can break it down for everybody. Cause there's a lot of moving pieces. And like he said, having a posse and a team and people helping you through this is so important. Cause it's like, with all these moving pieces, just trying to figure it out on your own is tough. But if you've got a team, like if you got family and friends and people that you've got on this call with you, it's so much easier. Mm-hmm. So I was a pretty typical CPA actually until it was like 2017, 2018. I was a real estate investor for about 10 years up until that point. But it wasn't until that point, I'm like, you know what? I'm just going to apply every single thing that I've been telling clients to do. So setting up my entity structure, setting up my partnerships, doing cost segregations, accelerated depreciation, just started to apply all this. And that's when it just took off for me. Like I knew it like from an accounting perspective, but not until I was actually applying some of the stuff myself. And like, that was the point when my mind just completely opened. I'm like, why is everyone not doing this? Yeah. And I think you'll all have you'll have a realization like that. Like with real estate, it's pretty common. It's like from the outside, it's like, well, people are worried, like right now with high interest rates, well, these interest rates are too high and cash flow isn't too great. Then you talk with someone like Alex, he's like, cash flow is important, but look at all these other benefits, the tax benefits, which we'll talk about today, and appreciation and someone paying down your mortgage and all the other opportunities you have. So it's, it's going to be fun. So I'm going to share my screen.
Okay, here, let me give you share. But before we also go on to that, it's so important to have a team because and Brent has also seen me grow. Okay, so just in the period of time when he came onto these calls the first time, when I was fresh in the game of like multifamily syndications, all these things up to this point, it's been like a little less than 3 years, maybe. I've been doing real estate for a long time. Like I know how to make money. I also really knew how to lose money too. I knew how to make money and I also really knew how to lose money. But having a great team around you gives you the confidence to push forward and go for big things, knowing that you have people that are experts around you. Right? I'm starting a massive fund right now. I'm like, I don't know, Brent, what am I doing here? Right? Like, what do I need to do to structure myself here in the right way? And also, how can we design it so that you can also help everyone else that's coming on board with me? Right? Like, and Brent said it. He's like, well, Alex is asking all these questions. I'm asking all these questions from a place of A, I need to understand it, and B, I need to understand it to a point that I can teach somebody else it. Because really teaching and mentoring is my passion. So if you listen from a space of you're going to go teach it to someone else here tonight, you will listen with like 120, 150% rather than like 60, 50%. Because not all the things may apply to you, but understanding it gives you a place to go to. If you're going to teach it to somebody, that's a whole nother level. So, okay, Brent, go ahead, share your screen. Can we talk a little bit first about, when I tell people that I made a lot of money and I paid no taxes, like Brent did my taxes. Okay. So he's not going to lie and I'm not lying. Like that happened. Yes, Brent?
That's correct.
Okay. Yep. So we took full advantage of
possible
depreciation and cost segregation, right?
You want it to, you want bankers and lenders at first glance to question your tax return, or you want them to be like, whoa, we're not going to loan that money to you. And you want them to dig in a little bit, like, okay, go look at the details, go add back all that depreciation. And then it makes them happier once they can add back the information. But like you could have a zero taxable income, but the underlying details, you could have $500,000 of income, $500,000 of depreciation expenses, completely offsetting that income.
Yeah. 2021, I had like negative $280,000 or something like that in my tax liabilities. That's how much I was supposed. The government, zero. You pay no taxes. Actually, probably more than that. You still pay no taxes. But My liability was negative 280 something thousand. What that means is I can take that money and roll it into 2022, and my 2022 taxes, I get to use 282,000 to depreciate off of that, to write against, basically.
Yeah, you never have to worry about having too much of a deduction, because if we're not using it that year, we just carry it forward to the next year.
Yeah. And then now
some
Brennan,
some people are afraid of that.
Yes. And now Brennan and I are talking about, okay, this is what we got to talk on a quarterly basis, because I got to say, how much am I making? What am I projecting to make? And then what do I need to invest? How do I not pay taxes? Right? Because the less taxes you pay, the more you can put it into investing. You can roll it in. And it's not like we're dodging taxes. Well, really, it's called deferring taxes. We're just kicking it down the road a little bit. But as you kick it down the road, you can use that money instead of giving it to the IRS to reinvest and earn returns on. And you get that money back by doing a cash out refinance. That's another piece of the puzzle we'll talk about another time. But I'll let Brent continue. Sorry, I just keep cutting you off. I get too excited.
No, and that's completely fine. Yeah, you can cut me off anytime. But really, it's like the mindset of how you view taxes. Like, it's on one end of it, it's like a horrible experience and everyone dreads doing it. And on the other side, it's like, all right, I'm making X amount of money. How can I reduce my taxes? It's really that mindset of asking not only yourself how, but professionals that you're working with how, doing your own research to figure out the how. Mm-hmm. And you'll start to find that there's quite a few, well, people will call them loopholes in the tax code, but I actually don't love calling them loopholes. It's really just parts of the tax code that might not be as well known, or parts of the tax code that are just clearly in there. It's actually designed that way. So like the way that the government, we'll talk about the government here in just a second in this new tax law, but they're promoting real estate investment. Like, they want people to invest in real estate to grow the economy and for all sorts of different reasons. And they do that. They try to get people to do that by giving the tax advantages along with it, allowing you to depreciate big parts of it to offset your income. Okay. So it's like, you're not avoiding tax, or you're not committing tax fraud. You're following the tax code the way that they wrote it to get the benefit that they intended. Okay. So I'm not going to I want everyone to see this tax law that has not passed. So Alex, when we talked a couple weeks ago, I was all gung-ho about this tax law, right? I was like, Alex, it's going to pass. 100% depreciation is back. Last week, I'm like, it might be back. This week, it might not be back. So here's my opinion of it. Well, actually, I'll show you guys the actual status of it. We track these actual bills. So if you're curious, it's HR 7024. The actual bill. It passed the Ways and Means Committee. It passed the House, and it was moving fast. And that's when I talked to Alex. I'm like, they're going to pass it. They're up for vote in a few days. And then they got pulled into fights with the stuff that the Senate fights about war funding and trading off things that one side of the party doesn't want. I'm like, can you guys just pass the tax law, then argue about that stuff? But if they pass it, so here's where I'm thinking now. In the way that it's currently written, I don't think it's going to pass. Part of the reason for that is some of the dates and stuff are going back to January 31st. It's going to impact some child tax credit stuff. I don't think it's going to pass in that format, but I think there's going to be something this year that will pass to bring back 100% bonus depreciation. So the great news is that it's on their radar. We think they're going to bring it back, but
okay. I want to actually bring us back first. So I think some people here might not even know what depreciation or bonus depreciation even means. So why don't we go and just bring it back to,
why does that even matter?
What does that even mean? Right. Exactly.
Yeah. Why is that? Why are Alex and Brent so excited about this? We'll break that down. So it's part of that. It's that number 3 that we're excited about. So here's why it matters. So here, if you guys, we'll do a couple of different examples. One is an example, if you just go buy a house on your own, what that could mean for you. So if you went and bought a single family house, and let's say you spent $100,000 on a single family house. We'll get into debt and leverage, all that stuff later, but you buy a $100,000 house. For tax purposes, it's broken down into 3 main sections. or with a cost segregation, it's broken down into 3 main sections. A building, land, and then we'll call this section like improvements. In this improvements category, that includes like floor, like if you look inside of a room, it's like all the fixtures, things that you could like remove without destroying the house, like even trim pieces and cabinetry, and all the exterior improvements. So like sod and hardscaping and any landscaping, trees, fences. Here's why that matters. So you got to understand just a little bit how it's broken down, but with depreciation, and this depreciation is like an on paper deduction, just on the tax return. Because think you've already paid $100,000 for this house. Now the accountant, or like as part of the cost segregation, we're trying to determine how much of a deduction you can get on that $100,000 purchase. In this example, these are just rough estimates, but sometimes they're pretty close. Let's say it's $50,000 of that is allocated, like goes towards, is from the building, 20,000 is from the land, and then you've got 30,000 of improvements. Like this one right here, I'm going to give that a star. That's our favorite one. You know why? Because that's the part of it that's eligible for accelerated depreciation. And so when you hear like the tax benefits of real estate and a big deduction in the first year, we're talking about that section, all those different assets. So what that translates to in 2022, that was a 100% deduction. In 2023, that's an 80% deduction. In 2024, that's 60%. So this is the part of the tax law where it can kind of get a little confusing. It's like, well, what is 100% bonus depreciation? It means we can write off 100% of that section right there.
In the first year.
In the first year. Yep.
Yeah.
Yep. So that's 100% in that first year. So if it was 2023, and here's what I don't want to get confused. This is the year that you buy it. So year of purchase. This isn't like these numbers up here. It's not like a new deduction every year. It's like if you bought that same property in 2022, that would have been your deduction. If you bought it in 2023, it'd be 24,000. So I'm just taking that 30,000 and multiplying it by the bonus depreciation rate. And that's the part of the tax law that we're hoping they bring back. So as you're like comparing properties, or if you're just looking at how the tax law impacts you, it's a pretty big difference. Buying one property, getting a $30,000 deduction if you bought it in 2022, or if you waited till 2024, that same property would give you a first year deduction of 18,000.
Yeah, and think about adding 1 or 2 or 3 more zeros to that. Like the number starts becoming massive, right? And then so what happens with the building and the land, Brent?
Yeah, the building and the land. So this is like the depreciation stuff, that this whole section. Land, there's no depreciation like at all. Like there's no depreciation ever on it. Improvements to the land, yes, that goes down in the improvement section, but land itself, no. The building, there is depreciation. It's just a smaller amount. It's like a 27-year life, meaning that you take that 50,000, and you can do this you could add a 0 or 2 to this if you really want to look at some big numbers, but you take 50,000, divide it by 27, you're going to get about an $1,800 annual deduction. So that one right there, that's the first year deduction, and also your same deduction for the next 27 years. This one, so like if you did buy that property in 2022 and we moved all this down here, actually I won't rewrite the whole thing, but if you took that property just in 2022, in 2023, the only thing you would have is that one. That 1,800, you're just gonna have that every year. In 2023, you'd get 24,000 for the first year, and the remaining you'd have maybe a little more because you didn't take as much in the first year, but you're going to have that building deduction over the long term.
Yeah. So really what this means for a lot of investors, okay, especially, so there's 2 things. There's one is you're a real estate professional, meaning you spend majority of your time on real estate or purchasing real estate or investing in real estate, researching lots of stuff. But you can take this depreciation off against any income that you earn. So any sort of income, be it capital gains, be it commissions, W-2, all of those you can write it against. All right. And this can actually work if you and your spouse are joint filing too, right, Brent? You can also, both of you guys can use the same deduction.
Yeah. That's why I tell people, or them or their spouse, to quit their job. I'm like, quit your job and do real estate, and you can have those deductions offset your spouse's income.
Yeah. And sometimes you actually keep more money by quitting your job, or one of you two quit your job. Okay. So that's like in that space. All right. So when people say cost segregation, Brent, this is what we're talking about here, right? You're forcing a lot of the depreciation from 27 years or long term to the first 5 years. Is that what you do with can you do that with the building part of it too?
Yeah. So the default, like if you just bought a building and went to go get your taxes done and you didn't do a cost segregation, the difference is that they're going to break it down into two components. They're going to say, okay, you have a building portion and you have a land portion. And they're going to put, like that example above, I'm going to use the same $100,000. They're going to say, okay, you got 80,000 in the building and 20,000 in the land. And so what you're losing out on, if you don't do a cost segregation, is you take that 80,000, you're just stuck with the default long-term depreciation. You're stuck with $2,900 a year. A $2,900 a year deduction. That's, watch this. So we'll go year 1, year 2, year 3. It's just $2,900, just a boring flat amount every year. You don't get any bonus depreciation. None of it's accelerated. And then with the land, it's just 0, 0, 0. So if you compared these two examples, I know they're not pretty, but down here is the no cost segregation right there. And up here is yes cost segregation. So the main difference, you actually are you're pulling it away from the land. Like, you're not the land, you're evaluating the building, or like we are, like if I was doing your cost segregation, we'd evaluate the building and the pictures and the property tax data. And we're trying to pull everything we can out of it and moving it to this other category, this one that I deleted, the one called improvements. Yeah. So we did I tell you about the hunting ranch that we did a cost segregation on, Alex?
With the RV parking thing?
There's an RV parking one too.
Okay, well, tell us about the hunting ranch.
Yeah, the hunting ranch. So I'm a big hunter, so the hunting ranch one is just really sticks in my mind. But they went and bought like 100 acres of hunting land in California, and it's kind of out in the middle of nowhere. But like from a high level bird's eye view, it might not look like much. Like it might look like, oh, it's just raw land. There's nothing to it. But the closer that you zoom in on this property, you start to realize it's like, okay, they got a ton of fencing. They've got roads and trails that they've built all over. They've got ponds, like water retention systems. And like they've improved this land a lot. It still looks like a hunting ranch. It looks pretty like primitive, but there's a lot of improvements. So as part of instead of like the downside, like if you bought, say, $1 million of land, instead of saying, okay, there's no improvements on it, there's 0 deduction for you. Mm-hmm. We went in and we had to estimate like how much it costs to build roads, like those types of roads, how much it costs to build the fencing. And we came up, it was like $700,000 to $800,000 of deductions that we pulled out of, instead of just letting it sit as land, not deductible. We pulled it out of that and put it on these improvement parts of the depreciation schedules. And so they got a $700,000 or $800,000 deduction in the first year.
Wow.
That was 2022. So it was 100% bonus depreciation.
Mm-hmm. So
they were ecstatic.
Let me ask the question from Simon real quick, the 2 questions he had, and then we'll kind of move on a little bit to, how this all applies to everybody and what that means, right? As an investor, as you're setting up to become an investor, what are all these things doing? So Simon asks, he's closing a deal this year, and if the bill passes and he does his cost segregation on a new deal, is he's stuck with 60%. So if he bought the deal this year, this is why you probably want to wait a little bit to do your taxes, for the bill to pass. Otherwise, you do it,
That's
you're
right.
going to have to re-amend it.
Yep. So if it passes and they pass it to the past, we might want to, we might re-amend, or amend the tax return.
Yeah, you can always go back and re-amend your tax returns. Okay, so that's something that you guys, it's not like once you file it, it's done. When I signed on with Brent, I was like, Brent, what happened to all of this? He's like, well, I guess we're gonna have to re-amend like the last 3 or 4 years or 5 years of your tax return. So I'm like, okay, let's redo the whole thing. I don't want to owe any money.
Redoing a tax return doesn't automatically mean an audit. We've had people worried about that. It's like, we've been doing this for over 20 years. We've never had an amended tax return audited.
Oh, look at that.
So it's pretty, the odds are pretty good. Just do it right, follow the rules, the laws, and it's allowed. But for Simon's question, so if you say you closed on the deal tomorrow, in the bill, like the new law is not in place yet, but then 6 months from now, say they passed the law, you're still covered. Like you could buy it right now, because the way they pass these tax laws, they just apply it to a full tax year. So you could have bought a property January 1st this year. You could buy it December 31st. The same tax laws are going to apply. So I wouldn't be worried about anything this year, because what they're going to do with the tax law is going to happen. The only thing I would hold off on, maybe if it's going to have a big impact, is like, say you bought a big piece of property in 2023 and you're like, okay, and say you raised funds for people, or you have a big tax bill and you're like, okay, if I wait like this, if this law passes, we could accelerate more of this depreciation. Like that's really the only thing I might wait for. But this week I've started to tell clients, like, I would just file. Like, it's a big unknown. It could take 6 days. It could take 6 months. I would just file now and then amend later if they pass it.
Yeah. So Sailor says, what does it mean to amend? Amend means you go back and change like certain things on the tax returns. Be like, oh, well, I screwed up here. Yeah, just redoing it. Like,
just
hey, we messed
your
up
tax
here.
return. It's like you get a second chance. And you can do it you can amend it as many times as you need to, but it takes the IRS a minimum of 3 months to process it. Like if you're getting a refund now with the IRS, like they'll send you a refund within 2 weeks. If you amend a tax return, it's like minimum of 3 months.
Yeah.
And you can go back. Yeah, great question, Sailor. You can go back 3 years. So we can still amend 2020's tax returns until April 15th this year. And as soon as April 15th hits, then we can only do 21, 22, and 23. But you have a kind of a unique situation right now where you can amend 2020, 21, 2, and 3.
Yeah, that's good to know. That's actually a huge nugget too. For any of you guys that, everybody probably will, if you sign on like a new CPA that knows what they're doing in real estate, you probably will be amending something in your past, especially
so
if
we did a tax return today. Someone that just came over like a week ago or a week or two ago. They're like, can you just look at my tax return? I'm like, yeah. And we found out this depreciation schedule, like the way that all this stuff is calculated, it was just done completely wrong. Like they didn't use the software for it. They were trying to just handwrite stuff in. It wasn't a CPA, but just an enrolled agent. And they had done it completely wrong. And so we redid the depreciation schedule, and they're getting, it's like $10,000 or $15,000 back.
Yeah, dude. And I'll tell you guys one thing too. This is also how my mentality was, and a lot of my friends right now is, if they own their business, everyone is trying to figure out how to get as much write-offs as they can. Right? They're like, let me write off everything so I make no money. But if you make no money, you can't go get any loans on anything either. Right? So you're just keeping yourself small. And that's literally what one of my buddies was telling me. He's like, dude, I can't pay for a CPA to do this. I'm like, dude, it's costing you way more not to pay a CPA. Right? Like Brendan and I, like, I'm just like, here, my credit card's on file with you. Every time I ask for something, just go ahead, like spending $10,000 is better than saving hundreds of thousands of dollars. Like I can't even, the value of it is insane. So yeah. And then Brent's going to talk a little bit about how to set up your structures here. But I also do want to go into like, what does it mean for people, how they should, actually, I guess this is how they should structure moving in the future.
Yeah. I was just going to, just as we're like talking about this, like a business owner that's like, okay, how am I really going to do this? How can I offset my business income? And from a very, very simplified just version of this, when it actually does not need to be complex, but just kind of showing like a structure like the one Alex might have. Like on one side, you might have an S corporation.
That I do have.
On the other side, you might have an investment holding company.
Oh.
Like investment or holding company, we'll kind of use those interchangeably. This is how it looks. He can show that his S corporation here on the left, you can show that a business is making money. You go, great, it's making $100,000 a year. But on the other side, you can have a real estate company, investments and depreciation, all these just paper losses that we're talking about. They can show that they're losing money. So when Alex goes to file his taxes, it's like, okay, he's got 100K positive on his personal tax return coming through these K1s. He's got 100K negative. He nets $0 of taxable income. Like that's how it works. And you can build onto that, have like both of these structures can own other businesses, own other real estate, but from a simple perspective of it, that's how it works.
Yeah. So real quick, it doesn't mean I lost $100,000, guys. This is paper depreciation. It's just what the IRS gives you as a way to write off against your income everywhere else if you were to do and buy real estate. Now, that's because I'm a real estate professional. Now, if they're not a real estate professional, Brent, how do they go and utilize this as an investor? Like before they become fully a professional real estate investor, and maybe you want to even just share what that even means as a real estate professional investor. How do you get that checkbox?
Yeah. So if we change this, like if your job, like your business is not real estate, you're not spending more than 50% of the time. Well, actually, I won't even copy that. But the first thing is like, what's a real estate professional? So that means you're spending 750 hours a year in real estate, and you're doing real estate or something real estate related more than your other job. So it's really hard if you have a full-time job doing anything other than real estate, you'd have to be working like 2,000 hours in real estate. So make sure if you cross that threshold, so real estate professional equals, just remember these numbers, 750 hours plus per calendar year, and you've got more activity, or I'll say hours, more hours in real estate than your job, like any other job. So that would allow you to offset any of your positive income with losses from real estate. But if you're like, okay, I'm not there yet, what happens if I have a loss on a K1, this depreciation comes through, what happens? Remember those, like the carryover losses we talked about, like that Alex had, we have carryover losses that we can move forward to future years. That's one of the things that would happen with the loss that you can't use that year. You carry it over to a future year to when you can use it. But one of the greatest things about real estate is that you could always offset your real estate income, your taxable income, with losses from other real estate or losses from the depreciation stuff that we've been talking about. So that's never going to be limited. Like it can offset itself, but it's kind of just self-contained and then just offsetting its own income. It can't break out of that shell until you're a real estate professional or you have a short-term rental. There's a loophole with that we could talk about. Or if your income is less than $100,000, Alex, we probably never even brought this up on a call. But when your income is less than $100,000, you can use up to $25,000 of your real estate loss, even if you're not a real estate professional. So you just have a single family home. If you're not spending 750 hours, just one investment, either one investment or one property. And if your income is less than $100,000, you can use up to $25,000 as a deduction to offset that. That's like at an average tax rate, that might save you almost $10,000 federal and state taxes.
Yeah, it's great. Real quick, let's see.
Yeah, there's a couple questions.
Yeah, Sailor asks, can we talk a little bit about material participation? Not sure what that means. Do you know what that means? Material participation.
Yes. And we could open up a little bit of a can of worms with getting into all the different hours. There are We won't have time to cover all the hours, all the hour requirements. There's an 100-hour test. There's a 500-hour test. This 500 one, that's material participation. Oh, man, if I could spell material participation, which in real estate specifically, so in long-term real estate, you have to meet the 750-hour rule. Because even if you meet the 500-hour rule, because real estate is passive by nature, like rental income, you'd have to meet that separate rule. But if you are a real estate agent, that's not passive real estate income. If you're raising money for real estate, that's not passive real estate income. They're in like these separate buckets. Or short-term rentals are not passive either. So if you're doing something else other than just a long-term rental, you've got these other tests that you could qualify under.
Oh, look at that.
Yeah, the 100-hour test. I've done some podcast episodes on it, and I've written some things up on it. But they get pretty complex pretty quick. But so if you have a say you start any sort of business, like not a real estate business, and just say if you have massive losses in it. So the IRS created these laws, and actually it doesn't have to be massive losses, but think of like two different people. A guy that starts his own business and he's just pumping money into it, trying to make a profit, trying to make products or whatever, self-services, compared to an investor that just gives that money to that guy, says, hey, make me a 50% owner. I'll give you $50,000. Go try to make a profit. The two examples of that, the investor and the actual guy running the business, the IRS tries to limit the investors from just giving people money and taking a deduction for it. So they actually want people, like you're rewarded for working in your own business. So that's kind of a little snippet separate from real estate, but that's why there's a material participation rule.
Interesting. I didn't even know that. So how do you qualify for the 100-hour test? What does that mean? 100-hour? You get 100-hour and you're a real estate professional?
Not a real estate professional, but it's related to this material one. That's like if you have a short-term rental or another business, like you can only do 100 hours as long as you've done more work than anyone else in the business. So that example I gave of the investor and the guy running the business, the guy running the business probably could have qualified under the 100-hour test.
And what do you qualify for? Are you a real estate professional at that point?
No, you just qualify to take those losses as well. So you know how like in real estate, you want to get the 750 hours. It would allow you to be like, all right.
So you're not a real estate professional, but you can take those losses.
Yeah. It's the different types of losses. But it actually, someone's question that came up right after this is very related to what we're talking about. Because think of all the other ways you can make money in real estate. Like there's flipping, there's wholesaling, there's brokering. There's a lot of these other types of ways to make income that's not just holding a long-term hold property. So long-term hold property, that's passive. That's real estate professional. We've got to meet those hours. The IRS, they have some extra hurdles in place for people to not take deductions on that. But everything else, like if you're wholesaling, you're running a business. If you're flipping, you're running a business. It's real estate related, but it's not subject to the passive, like the passive loss rules where the IRS has all these extra requirements. So think of that as you're trying to decide if you can deduct things. If you're, say, a CPA or tax preparer is like, no, you can't write that off. It's passive. Like, no, I'm flipping houses. I'm running a construction company, basically. Like,
well, yeah, they're definitely not passive.
That's important to know.
Can they take depreciation losses against those active incomes?
If they have losses, like if they buy a property, let's do a specific example.
So I make $100,000 on a flip, and can I take my depreciation against that $100,000 that I made?
With the flip, because that you bought the house, put improvements into it, and sold it, you're not going to be holding the property at the end of the year to qualify for any depreciation.
I mean, if I had other investments, if I had other depreciation.
now, like all the work, this work gets really fun, and I'm glad you're bringing these together with your questions.
Trying.
If you run a business, wholesaling business, any other way you can make business with real estate, if you're the business owner, all those hours can count towards your 750 hours. So that is critical, absolutely critical. You've got to understand that. I may have told you about the guy that I had a land surveyor client, surveys land. So he's not building real estate. He's not renting real estate. He's a land surveyor. He had his own S corporation, just surveying land for people. He's as a business owner. And he had quite a few rental properties, and he had never accelerated any depreciation on it. And he's like, yeah, my last CPA told me I wasn't a real estate professional. I'm like, I'm like, you survey land. What's look up the definition of real estate in Wikipedia, like land. You are the definition of a real estate professional. He's like, I had no idea. And he saved hundreds. We went back, like not hundreds, hundreds of thousands of dollars. We went back multiple years and filed them. That it was amazing. So if your job, so here's the catch, you can't, because I don't know if anyone's asked this yet, but a lot of people go, oh, if my job, like if you have a W-2 job and that's related to real estate, like say, for example, say Alex hired you to do something real estate related. If you're a W-2 employee, that can't count. Those hours don't count. You need to own your own business for those hours to count towards real estate professional hours.
What if they were outside contractors? Let's say underwriter. I can hire an underwriter under our company, or I can hire you as an outside contractor. Now can you qualify?
Yes. Yep.
Yeah.
That's why, like, being a W-2, I think the more and more, like, I just think the more people learn about this, the more you're going to want to be an independent contractor. You're going to want your own business. You're going to want your own LLC. You're going to want your own S corporation. Like in this example, we said this was Alex over here. Alex's business would pay money out to a contractor, which could be someone else's S corporation. Let's just say it's Joe's S corp. So Joe's S corp makes money. Joe owns that. So we'll just say he paid out all of his profit. 100,000 goes up to Joe. And Joe's like, I don't want to pay tax on that 100,000. So Joe goes and buys some real estate. In this green triangle, if you see any of my videos or watch any of those old videos, I'm drawing these same shapes and colors to help people recognize them. You have an LLC own your rental property. Joe could go create a deduction with rental property. And say in this example, it was the $100,000 property we talked about. So he buys a $100,000 property, do a cost segregation. We got 50,000 a building, 20,000 of land, and then this one, there's the $30,000 of accelerated depreciation. He loses 30,000 on paper, didn't actually lose it. And then if we summarize his tax return, it's positive 100. We take out 30. He's got 70,000 of taxable income. So if you've got friends, or you could even go to if you are employed by someone like that, you could go to your employer and say, hey, I want to be self-employed. Can you pay my S corporation? Mm-hmm. That's definitely possible.
Now, hey, Brent, this kind of relates to this LP question that's being asked right now. So if that's a $100,000 property, right, and I put $20,000 down, what kind of depreciation am I taking on that same example right there?
So same, if you have a $100,000 property and the LP puts down 20,000.
20,000. So they put down the 20%.
Okay. So whatever the LP ends up owing, or not owing, whatever the LP ends up owning, like whatever percentage of the partnership the LP owns, that's the percentage of the deduction that they'll get in the end. Mm-hmm. So if it's, let's break down this property. We'll say this is the LLC that owns or has the LPs and the GPs. So there's the LLC.
Okay, just real quick for everyone to know, an LP and a GP. GP stands for general partner that operates and runs the deal. LP stands for limited partner, usually just passively invest into the deal. Okay, so we're looking at right now percentages of the deal itself. So the deal, Brent, first, my question was, if the deal costs $100,000, the down payment is $20,000. Okay, how much can this person that owns this property offset? Do they offset the whole thing, or they only offset that $20,000?
So this will be the LP doesn't own 20%; it's 20% down.
Yes.
So let's just
we'll go back to the LPGP after, but yeah.
Okay. Let's just say the LP owns 90%.
Okay. All right. We'll go
there. And we'll say GP owns 10. But as you guys all know, that could change.
Yes.
So the dynamics of it, or the what's actually happening, money from the LP goes in, 20 grand, buys the property. You got a 20K cash, right? And then 80K loan on it for a total of 100. So even though you've only used $20,000 of cash, we're still taking the deduction based off of the purchase price. So then, like I've broke down on those other ones, we're breaking the purchase price down into 3 parts. We're going building, land, and other, or the improvements. This, and it's a pretty low estimate at $30,000. That $30,000 is what's subject to bonus depreciation. So if it's at 100% or 60%, that's a pretty big difference. If it's 100%, that LP is going to get a $30,000 deduction. They put in $20,000 of cash, they get a $30,000 deduction, which is pretty sweet. If it stays at the 60% depreciation for 2024, their first year deduction would be like $18,000. That's 60%.
But it's still almost 100% written off.
Yeah. So I think 2024, is still, even at the 60%, is great. Like, you're still about
offsetting. Are they trying to run it to zero? Are they trying to run it to zero?
Yeah. So 2025, it's 40%. 2026, it's 20%. And then it's zero. After that point, you still get the regular depreciation, but it takes you 27 years to get it.
So Simon says, wouldn't it be 27,000 since they own 90%? So if the GPs, yes. So yeah.
Yes. Yep. I didn't split the 10 and 90.
There you go.
And we could.
Sometimes GPs don't take it. Sometimes GPs take it.
Yes.
Okay, so that's the.
Yep. Sometimes GPs, like, the default is that it's just split based on ownership, but sometimes you can split the losses to LPs first. And it's just up to negotiation, or just up to however it's structured.
Yeah.
So Alex, I've not brought this up on a call.
What?
But there are certain types of assets. And so what I actually, because we get so many questions about this, I'm going to send this over to you. I've never sent this to you, but
okay.
Like, I know sometimes your text, you're like, okay, roughly how much is this one? Roughly how much would this type of property get? Like, I'm making this for Alex.
Okay, great. Perfect.
So if you went and bought a gas station, so there's like gas stations and car washes have just a carved out section of the tax code where it's very advantageous to buy one of those, because you can write off potentially up to like 95% of the whole thing in the year that you buy it. So if you take the $100,000 purchase price, we've just been assuming like a single family home, but if it's actually a golf course or a warehouse, vacation rentals and like single family homes, multiplex homes, I put a range of 25% up to 45%, because the average is probably closer to 35. But in my examples here, we've been using 30%. But car washes, some of these other ones, it's like an insanely high amount compared to the overall total.
Mm-hmm. So what if they go on to get it to zero? And Lyle, I'll get to you in a second. Sorry, I just saw that your hand was up. I think I saw it for a little bit. So what's going to happen? What do people do once we go into, 2026 and we're just at zero now, or 2027? Do we don't no longer do cost segregation? Is that an industry that's just going to go bye-bye or what?
Yeah, like the companies that are only doing cost segregations, there could be some benefit still to those cost segregations. And here's why. So like right now, the default, I told you the default depreciation, there's two methods, right? Or it's you take your building, depreciate that over 30 years, take your land, you get nothing. But the new cost segregation like industry, it's going to shift from saying, okay, instead of taking your building over 30 years, we're going to change that to the real life of these underlying assets, which is going to be 5, 7, or 15 years. This is actually, so there was a cost segregation industry before 2017 with all the law changes. That's what they were doing. They were taking as much as they could. Say it's carpet. Say you have an apartment building and you got $100,000 of carpet. Instead of taking $100,000 deduction over 30 years, you can take that $100,000 deduction over 5 years.
Okay. So either way,
there's
cost
still
segregation
somewhat
is
of an
there.
acceleration, but it's not like a first year acceleration.
I mean, it's still pretty good if you can take a big chunk of the building and shove it into the first 5 years. I mean,
yes. Yeah. So if you took $1 million building and it's say $300,000, we're like, yeah, we're not writing off $300,000 over 30 years. We're writing off $300,000 over 5. You get a $60,000 annual deduction for 5 years instead of a $10,000 deduction over 30.
Yeah.
So there's still going to be
works.
benefit.
It will still work. Right. So now what we're doing with cost segregation is we're pushing the acceleration and we're pushing the building to the first 5 years.
Yep.
Yeah. So you get even more deductions than just your typical. All right. So how does the recapture work? Okay, so like basically when we sell the property, right? Is what Jaden's asking. Yeah. Wait, hold on. Before we get to that, Lyle had a question. Go ahead, Lyle.
Oh, it's okay. I'm paid. Hey, Brent, thanks for being here in your time. But hey, I'm a pilot for United, so I'm technically full time. But like when I look back at my 12-month history, I only flew like 567 hours last year. How does that kind of play into like the real estate professional criteria?
Yeah. If you could make a case, and actually I'll go back to the 750 hour requirement. The way that's logged, or like the way that it's tracked and logged, is all on you. Like as the taxpayer, it's like your own logs. You're a pilot, so you know how to do logs really well. You'd be logging your own hours as a real estate professional, putting it on your own calendar. And from the tax preparation side, we have a question in our questionnaire that just says, are you a real estate professional? These are the requirements. Tell us yes or no. You check the box. We just go and check the box on the tax return. Okay. You're not submitting those logs. It's not getting audited. Well, in the rare chance of an audit, if the IRS is like, let's go ask Lyle, or let's go ask Lyle to prove his 750 hours, then that's when your logs get really important. The IRS never has those ever until you're either randomly audited or they just want to ask about it. And then you just say, well, I flew 550 hours. I had all these real estate hours. It was 750. It would just kind of come to a negotiation at that point and see if it was believable.
What about logging this meeting? Is this meeting loggable?
So I've told people the hours, if you have general education hours, even if they're related to real estate, you would not log those hours. But if you are like, say you're in the middle of a deal and you're like, the key piece of information I needed was in this meeting, or you needed something to like figure out that specific deal, I've told people that I would include those hours.
So you would, all right? For you guys that are here, there is no way that you're not hearing any of this stuff and just being like, oh yeah, it didn't help at all. Like this stuff helps, okay? And even if you go back to it, it's going to be on a YouTube replay. So you can log this, and you can even log it when you go back to watch it again on the replay. All right? So this is important right here for you guys. So great job, Jaden. Yeah, log this meeting. So for Lyle's right there, he flies for 500 something hours. He does real estate for 750. Is that enough to be a real estate professional?
It is. Yeah.
So that means
Okay.
he can invest in real estate and his depreciation actually depreciates against his flying income.
It could offset his flying income. Yep.
Damn, dog, you'll be the
Okay.
only pilot I don't have to pay any taxes over there.
So
That's what's
Lyle,
up.
you make your income's on a W-2, I assume.
Yeah. Mhm.
So here's your structure. It could be as simple as this. Say if you invested in, I'll just do the property example again. Say you have 100% of that property and you have W-2 income up here. And let's say your W-2 is 100,000. And we've been throwing that $30,000 amount around. That goes up there. That depreciation can offset W-2 income as well when you qualify as a real estate professional.
Wow. Okay.
And if it's, and I've gone through some of the exemptions, like ways around the like the passive loss rules, but real estate professional, short-term rental, having your spouse be employed, or having another job that's real estate related to get you over those hours would all count.
Wow. Okay.
So we have quite a few. We have some pilot clients, but quite a few doctor clients that will do this and get into real estate. And a lot of times it's the spouse that's into it, or on every once in a while, it's like we have a doctor that will take a bunch of time off, or they'll get into short-term rental. Like if they're not married, it's like they got to do it on their own. They got to qualify. We had one guy that he ended up like, he's really handy. I wouldn't be doing this, but he's like building, like doing a ton of the construction on a new property. And he just took a lot of time off, and he spent more than the time he was spending as a doctor, just because he loved doing it. And he qualified as a real estate professional that year.
Okay.
And as long as you qualify in that calendar year, you
Okay.
check the box that year. And the future years are just down the road. The future years, you're not going to recapture that depreciation. I know someone had that question. You're not going to recapture it if you are no longer a real estate professional. Like just the hours alone don't make you recapture it. That's only when you sell it. Then we start running some projections and estimates on recapture when you sell the property.
Okay.
Awesome. So, Alman, can you? He's got a question. Go ahead.
Hey, Aaron, I just have a quick, like very basic question. If I'm an active GP, like with a full, like let's say asset management role, it's over 300 units, would I still need to create a log in order to just safeguard myself, or just showing them, hey, I'm invested in these deals and this is my role is good enough?
If they ever questioned your real estate professional status, you may need to come up with a log. Like if I was helping you in an audit, I'd say you're going to need that log created before you go into the meeting with them, just because we got to somehow log the 750 hours. Like I do it. I'll just put it on a calendar, like on Google Calendar. Like you can like block out time, and then at the end of the year, you can see like how many hours you spent with like one of your specific calendars. I have my main calendar, then a bunch of sub calendars. But in my specific example, my wife is the real estate professional.
Got it. Okay, thank you.
Yeah.
Brent spends way too many hours just doing taxes.
You guys should see the text threads with my wife. Don't worry, they're all real estate related. But it's like she literally just sends me stuff all the time about real estate. She's like, well, how we could subdivide this property, and I've trained her about subdividing properties and looking at land codes. And she sent me like a 1 acre parcel in Hawaii. But Hawaii's short-term rental laws are crazy. If anyone's familiar with that, it's really hard to get grandfathered in or whatever. But like, yeah, she's very creative. And yeah.
Awesome. All right. So Simon's going to ask the last question here. And actually, Sailor's going to ask the last question. But Simon, go ahead, ask your question. Then Sailor's going to go. And then I'm going to let you guys break out. But before I do that, I actually want to just do a quick I don't know, plug right here. So March 21st to the 23rd, we're actually going to be having a live event in Las Vegas. Okay. This is actually going to be really, really big because we're going to talk about so it's going to be intimate. It's going to be about 200-300 people. We have Brad Blazer, Jeffrey Hazlett, like some of the big guys. I'm going to see if Brent's going to be able to make it. Maybe Brent will come.
I'm coming.
He'll be our surprise speaker. But there is a section where we're going to teach you guys how to pitch and how to bring us deals, because this year we have $500 million that need to be deployed into deals, whether it be debt, equity, something like that. So we're looking for that. All right. If you are trying to get into real estate, you have got to be there and learn that aspect, because you can raise and you can do deals literally without having to actually raise capital. I'm going to teach you guys and show you guys how to do that. And we're going to be doing a deal tank again. We're going to be running it and teaching that. For sure, come to that event. Get the VIP ticket, because you're going to be able to hang out with my partner and I, Jeffrey Hazlett, Brad Blazer. Like, if you guys know, like, just research these guys. Like, they're big. All right. And the last event that was thrown, the 360 University, that I'm partnered with, this is not my event. Okay. I just partner with them. I was there, and the people that I met, literally, we're doing a $280 million deal together right now. All right. I met somebody at that event. That's the caliber of people that my partner Jacqueline draws, Proxy Financial draws, and also Jeffrey Hazlett, Brad Blazer. And it's a small, intimate group where you're going to meet people. And I promise there will be definitely information and people there that will change your whole life. And Vegas is dope. And we're going to show you guys a lot of that. We'll maybe do like a bus tour or something of all the projects that we're going to be working on out there. So, maybe we'll play some craps together. Crapless craps. That's my new favorite game. We literally could not stop rolling 2s and 6s, and the pit balls came and everything, and was like, what's going on here? How are you guys putting $100 on 2 and 12 and rolling it and hitting 6-1 odds like over and over? It was crazy. So come for the 21st. Nick just dropped a link in there, so definitely come check it out. Come hang out with us there. It's going to be such a great time. Promise you. Go ahead, Simon.
So I'm doing my first deal right now. It's a 96 unit deal.
Congratulations. Let's go.
So we're just, going, we just got the blank contract. So my attorney's looking at it. We'll be definitely doing cost seg there. So, I have some unique background where I have some deal flows coming. So having said that, at 60% for this year, at what point when you're doing timeline where it would make sense or not make sense doing cost seg? In other words, like, let's say if my horizon is 3 years, is it worth bothering doing it at 60% bonus?
Yeah, it's a good question. It really comes down to each individual investor.
Yeah.
To see if they would like as an example, like a more extreme example, say you bought the property this year, depreciated 60% of those parts of the assets that we talked about.
Yep.
And then next year you sell the property. So say you just held it for 1 year. It's like, okay, what's the impact of that? So the good thing is that you've accelerated part of the depreciation. And for the investors that could take that depreciation, like, that's great for them. Like, if they were in a high tax bracket year, they're going to be happy. Like, they're going to offset some income. But then the very next year, when you sell it, their capital gain is going to go up by the amount of depreciation that you took in the first year. That's the recapture. And so if they're not deploying that over into, like, say, an opportunity zone fund, or they're not getting into, or an opportunity or real estate just in an opportunity zone, or they're not getting into other real estate to offset the gains that they just created, then those investors might not want it. They might be like, well,
let me complicate that for that second. So my deal sits on an opportunity zone. But I won't be spending enough money on CapEx to make any sense of it.
Okay.
And then the deal's dynamics is such that I can't even front load all the CapEx. It'll be broken up into year 1 and year 2. So if I'm doing it, I cannot depreciate second year CapEx on a accelerated basis, correct? Just I can only use what I spend this year on the bonus side.
Well, if you have second year CapEx,
yeah,
when you're placing new assets in service, because like even though you've already bought the property, new capex in the second year is considered a new asset and it's bonus depreciation eligible.
But it will be 40%
It'll be
for
40%
next year.
at that point.
Okay.
Yeah.
Yeah.
But
Okay.
Brent, also the property itself, the building that you're taking, you're also depreciating that in 5 years, right? You're also pushing that 27-year, that portion
That's right.
of it up
Yeah.
to
So
the
the cost
5.
segregation.
So you're still getting a chunk of the building. You're getting 20% of the building as well for the cost seg in the first year. You're gonna, so a lot of it is,
it wouldn't be 20%
Well,
of the
yeah.
total building. We're pulling out as much as we can.
but something bigger than your normal.
So, I mean, my thought process, a lot of people don't necessarily get that, but I figure even if you have to recapture, you're technically paying in nominal dollars in the future rather than real dollars of today. So you're still do better off paying in nominal dollars.
Yeah, I think I've run a lot of numbers on that, and it's been a lot of like one-on-one consultations with people, even in the very next year. And it's more likely than not making sense to depreciate as much as you can in the current year.
Yeah.
A scenario where it might not make sense is if your income is very low this year and it's going to be very high next year.
Yeah.
Like not from the sale, but just from other sources.
Sure.
Then it's like, well, maybe we just rather not deal with it. But
So, and my last question, I don't want to hog this. So if you have an LP that doesn't qualify as a real estate professional, so do you just negotiate up front, say, hey, you can't use this crap anyway, so can we keep it kind of thing?
yes, you can. Yeah.
Okay.
Or no, not saying you can without negotiating with them, but I have seen that part of the operating agreement creation. There's some LPs that are like, I don't need it. I don't need any allocations of the depreciation. Let the GPs keep it.
Yeah,
Or
I just don't want to
set of
misspeak on, the misspeak, just globally telling every LP, say, hey, you get depreciation participating in this, and they end up, they can't use it.
Yep, that's why
that would be ideal for a GP. You'd bring on all the LPs that can't take the depreciation, then you take all their depreciation too.
I mean, I'm sitting down with one next week, and he's gonna dump probably about $400,000 into the deal, and I'm not
it's
sure
hard.
he can
It's like,
use it.
well, Alex, and on these calls, you guys do really well. It's like we're identifying that up front. Like we don't want someone to be surprised because it's like a K1 goes to the taxpayer or the LP. They send it to their CPA. If they hadn't done planning, they weren't expecting it. If they can't use it, the CPA is going to say, you can't use it. And so talking with them early, that's great that you're doing that. Maybe give them some alternate or some options or ideas on how they could potentially create a scenario where they could use it.
Yeah. And this is the value also of being on these calls. Like this is his first deal and he's doing this. When I did my first deal, first of all, there was no Zooms going on when I was doing my deals. So nobody was teaching me crap. Like I did my first syndication as like a JV deal. Now we didn't have a lot of partners, but I was like, what am I doing? Right. So, and he's asking these types of questions up front. I didn't know to ask these questions up front. Right. So this is why the value of being here, even if you have not done a deal yet, you're learning and you're hearing these things. And then at some point later in the row, when you're about to do a deal, you're like, wait, I remember something that was said about this specific part right here. Let me go back. Let me go find Alex and be like, what was that? Which one was that? Or who was your CPA? Let me ask your CPA that question. Right. And then, cough up $1,000 and you can give Brent a call. I'm just kidding. So anyways, let's move on. I know Sailor had a question. Thank you, Simon. Thank you for all the great questions you've had.
Great questions today, guys.
Awesome. You can tell that Simon is definitely like an operator that you want to be working with just based on his details and him looking for the information, right? I imagine he's someone that seeks this information and wants to do it correctly. Go ahead, Sailor. Are you still here?
Yes, I'm still here.
Hey,
okay.
Good to see you.
Hi, Alex. How are you? So I have a question. I don't know how relevant it's going to be for everyone else, but so we have one rental property, and I'm just trying to figure out ways that we can is that how you say it, right? Materially participate or claim rep status. So previously, when we did that one rental, my husband owned a plumbing company, and now he doesn't. And so I'm trying to take on the rep status of it. And so we are starting a podcast where we interview startups, like people that in all walks of life that have started up a business. And so how would you feel if I use that part? Would that count in any way as like an active business in real estate if we are interviewing like people who are in real estate or starting their own business, but we are also interviewing other types of people?
I don't think that would count. Like,
Okay.
I would be very confident in saying that wouldn't count, like the interviewing process or the podcast.
Okay.
But I hate like telling people no. As Alex knows, I'm like, how could we brainstorm an idea to make that work? So I'm like, well, maybe you could be like interviewing them at your rental or doing something or having some sort of real estate related project. But
Okay.
it's, yeah, like talking about it, the education part of it wouldn't count. But if it's
Okay.
applies to a specific property or your investment, or even if you're managing tenants,
Mhm.
or yeah, that type of thing. Or maybe you convert it to a short-term rental at the end of the year.
Okay.
And just carry it as a short-term through the end of the year. The short-term rental rules just have the fewer hour requirements, and
Okay.
might be able to qualify. Then a year later or just later convert it to a long-term at that point. We've had a bunch of people do that too.
There's definitely a way to do it. That's what I always believe. Whenever I talk to Brent, I'm like, come on, man, there's got to be a way. How do I need to position it? What do I need to say? What do I need to show? Where do I need to be to make it happen, right? All right, JJ, cool. See you later. All right, last question, Fraser. That is it. Last question. I'm going to give you guys a chance to break out. Seriously, leverage that opportunity to break out and meet each other. All right, go ahead, Fraser.
Okay, my question's actually because of what Sailor said. Would it be possible for her to do something like some sort of advertisement in the way of real estate for that podcast in order to do that write-off?
If she was doing an advertisement for a rental property, she would, but yeah, how could advertisement be related to real estate specifically? I can't think of anything off the top of my head.
All right, I guess we're
What
going
if,
into
like,
let's brainstorm it.
What if I was like, got my real estate agent license and I was like saying, use me as a real estate agent? Would that count?
That now we're talking. Yeah, like that's how you come up with deduction. Just start thinking of it like that. Your hours as a real estate agent, like actively trying to help people buy and sell properties, those hours would count. So in that
But
case,
if I was like in the podcast, like putting a little plug in, like, hey, I'm also a real estate agent, use me. Could I use those hours for that?
So, and you'll note that like a lot of the answers I give are never like yes or no. But
yes, yeah.
Because they're really not yes or no. But like say if I was an IRS agent,
privately.
Maybe privately I'll tell you yes or no. Like if I was an IRS agent, and if I was looking at your log hours, and I'm like, they have one rental property. So they have one rental property and a podcast. They're claiming real estate professional status. That isn't very likely. Like it would just be harder to believe compared to they're looking at your log. They're like, oh, she's a real estate agent. She sold some houses, had some sales, and it doesn't need to be a crazy amount, but she had some sales. She passed the test, and they do a podcast. That helps advertise. Like I think that would complete the picture.
Okay.
Like that would be a major step in the right direction to qualify for that.
Okay. Hey, just shout it out for everyone. If you need a real estate agent, I'll be coming.
Hey, all right,
Those
counts.
hours.
It counts. Log it.
Yeah, that's awesome. That is
all
awesome.
right, cool. Listen, Brent, thank you so much for saying yes and being on here. We always have a lot of fun every time we talk. So,
Glad to be on here.
Great. So, give yourself some plugs. What do you need? What do you got going on? What do you want people to see?
Yeah, so I've tried to get, as Alex knows, I'm busy, and just over the last couple of years, I'm like, okay, I'm busy, but I got to get this stuff out there. We want to bring on new clients. We want to just get as much information out there as we can. So I did start a podcast, Wealth Game Podcast. It's on all the platforms, or if you go to wealthgame.io, you'll see it there. And if you go to wealthgame.io, if you're like, okay, I want to see like maybe a little more detailed information on some of these videos and the structures that we've covered, I just have like a free course it's got like 4 or 5 hours of videos on it. That's just completely free, just for people to just go and watch. We got some templates on there. But we do have a group that has more detailed and ongoing live calls and stuff as well for people that just have a ton of burning questions. But then if you're like, I don't want to do this, or my CPA doesn't know how to do this, or my EA or tax preparer doesn't know how to do this, and if you want to hire our firm to prepare your tax returns, we are taking new clients. I know, Alex, I told you, I think on the last call, I was like,
You're not
taking new clients. So December, we opened it back up. So we took a hiatus like July last year to December. We had to close it because I was hiring new employees, setting up processes, training the employees, and we opened it back up in December. So we're taking new tax preparation clients. And I'll have, if you go to, we've got 2 main websites. beementcompany.com is the tax preparation and the CPA firm. And then wealthgame.com is the education stuff. But they're all owned by me and they're linked. And we're trying to do better at like integrating the two. But yeah, we'd love to have you on like in either one of those realms.
All right, there you go, guys.
Thank you, Alex.
Don't not have your taxes done correctly. There's no excuses now. All right. So, all right, cool. That concludes. Anything else, Brent? Last words?
No.
All right, cool. You're the man. Thank you. Thank you for coming out. Try to spare those animals a little bit next time. Just kidding. All right. Cool. We're going to break you guys out. Let me see. Nick's going to break you guys out. And does anybody have any burning questions they want to ask before we break you guys out? We're doing one breakout room, 15 minutes, get to know each other. People have found game-changing partners on these calls. All right. I know for a fact that there is other syndicating partners out there, big teams out there that met each other on this call here. I know, and they're running Zooms and doing things together. And then there's people that have found their business partners on here, investors, all of it. So Hawk can't talk, but everybody else, Nick, break them out into the rooms. And I'll see you guys next Monday. All right. Peace. And you're very welcome, everybody.
Recording stopped.
All right, Nick, I got to run.
Okay. Want to make me host?
Yes. All right. How we do? We did good?
I was good. Brent's always a hit.
Huh?
Brent is always a hit on this.
Yeah, he's awesome.
Guess what? I have a snow day tomorrow.
That's what your dad said. I have a call with your dad at some point.
Yeah, snow day tomorrow. You're getting a foot.
Really?
Yep.
All right. Well, stay up late because when I get back,
We're playing Fortnite.
yeah. So even if you need to take a nap, no, I got my new headphones.
No, I'll be up.
All right.
I'll be up. I took a nap already after school.
Bro, check out these new kicks.
Damn, what kind?
How cool is that?
Where are they?
Karl Lagerfeld. I don't know. I don't know who that is. I saw these shoes. I was like, look at this. It looks like a boss.
Get them. Nice. What time do you fly out tomorrow?
Oh, shit. I got to book my flight.
book your flight. You haven't booked it yet?
No. No way, I
Oh.
did. I just booked it before this call. I fly at 6:20 p.m. tomorrow.
So no Tuesday night call?
Oh shit! No. Somebody else can run it. Tell Donna to run it. Bro, the flight was so expensive. One-way flight, $600.
Yeah, because you booked it a day in advance. You're turning it to Justin. This is why we need a plane.
I do.
Instead of a $10 million warehouse, buy a plane.
No, can't. We bought a warehouse.
That's going to be dope, though. I'm excited to come to Vegas. And I should probably book my flight for Jacqueline's conference, too.
You should what?
I'm going to come to Jacqueline's conference, too.
Yeah.
All right, so I should book my flight.
Mm-hmm. No, but I don't have the address. I don't see it on there. I did. I don't see it. Hold on. Okay, just text me. Okay. Awesome. Bye.